The ads are everywhere. They're on TV, the internet, and even in your inbox regarding the coming retirement tax bomb with the backdoor Roth conversion as the proposed solution to fix the problem. If you've seen these ads, you know the wording is enough to scare the crap out of you. I mean, really, Brian? Who wants to
Exactly.
take, who wants the tax man to take all their money? No one,
No one.
right? But the word choice is meant to scare you into making a conversion, taking action, right? And giving a company your business. But before you write it off as just a marketing scam, you need to know there's a lot of validity to it. Hi, and welcome back to Stop Being Sold. My name is Michelle, and I'm here with Brian. And in today's video, we're discussing the backdoor Roth conversion and the exact details that you need to understand before you make the move. If you want to save your hard-earned money, hard-earned retirement savings from the IRS, then you need to make sure you watch this video to the end. So Brian, before we define the backdoor Roth conversion, let's take a step back a minute and talk about this retirement tax bomb that usually precedes the backdoor Roth.
Of course, we got to talk about that first, right?
Okay, right?
Okay. The retirement tax bomb, Michelle, refers to the massive IRA 401k tax burden that could hit income earners in their retirement years.
Right.
And it applies to people who accumulated assets pre-tax for decades to, just to lower their yearly taxable income. And now that the accounts are much higher, the taxman cometh.
Always.
Always. So think of it like this. Contributions to a 401k are made pre-tax, meaning they're deposited before your income taxes are deducted from your paycheck.
Right.
The amounts are tax deductible, thereby reducing your taxable income for that year, right?
Right.
So, but now we're in retirement. Withdrawals are taxed at your then current income tax rate. And to alleviate this burden, financial planners, CPAs, and even tax advisors start talking about using the Roth IRAs to lower taxes in retirement.
Okay.
And because there's no tax deduction for contributions to a Roth IRA, and contributions and earnings can be withdrawn tax-free when in retirement.
Okay, so you said this applies to high income earners. Like, don't they make too much to do a Roth IRA each year?
Yes,
Or to have
yes,
one?
they do. That's why it's called a backdoor Roth IRA
Gotcha.
conversion.
It's a loophole.
So,
Okay.
yeah. So a backdoor Roth IRA conversion allows you to convert non-deductible traditional IRA contributions to a Roth IRA, even if you make too much money to do so.
Okay, so what constitutes a high income earner? Like, how much are we talking here?
Yeah, so for 2022, if you're single, over $140,000, and married, filing joint, the income limit is $208,000.
Okay, all right, so that constitutes a high income earner.
Yes.
Okay, so can people with less than that saved also do a backdoor Roth conversion, or do you have to have a specific amount or be over that limit you just mentioned to do this?
That's a great question. But honestly, Michelle, there's no reason to do it, as you can fully max out a Roth IRA with the lower incomes anyways. So there's no reason to do a Roth conversion.
All right, makes sense. So explain to us how it works.
Okay. So first of all, you need to open a traditional IRA and max out your non-deductible contributions to it. So if you're under the age of 50, that's $6,000 for this year, $7,000 over the age of 50. Next year, it's $6,500 under 50 and $7,500 over the age of 50 for 2023.
Got it. Okay.
Okay. So once you do that, you immediately convert it to a Roth IRA. And I mean immediately, for one reason. This way you don't earn interest on them contributions, and that way you pay no taxes on that conversion. So if you do this every year that's available, you'll accelerate your retirement earnings. It's funny, Michelle, the Build Back Better Act was trying to eliminate this strategy.
Yeah, this seems like one they're going to want to wipe out if they can, right?
Right.
Yeah. So I want to be really clear here on how this works. So what you're saying is you open a traditional IRA, then you're going to add non-deductible contributions to it, and then immediately convert it to a Roth IRA.
Exactly.
Okay. So for 2022, let's say you're 52 and you get to move 7,000 total from your 401k into a traditional IRA, and then transfer that to the Roth IRA. Is transfer the right word?
No, you can't do that. You can't just transfer pre-tax money into a Roth. You must add non-deductible contributions to an IRA first.
Got it.
Then convert these funds to the Roth IRA.
Okay. All right. So maybe this might be a good point to just ask, can you define very clearly for us what non-deductible contributions are?
Yeah. Okay. So, every year that you put into we talk about on the channel a lot, how much you can contribute each year to your traditional IRA.
Right.
Okay. So for this year, it's $6,000 under the age of 50, right?
Sure.
Okay. Well, that is pre-tax money, meaning
Sure.
that if you make $50,000 and you put in $6,000, like in your 401k, same thing, pre-tax. You put in $6,000, that gets subtracted from your taxable income for the year. Okay. Non-deductible means you can put into that amount, same amount, but you don't get the tax deduction for it. That's why it's called non-deductible.
Got it. Okay. All right. So we've touched on this a little bit. You mentioned the strategy is for high income earners, but who else is it? Who else is it good for?
Well, definitely high income earners. It must be a high income earner because there's no sense of doing it any other way. This is best for someone who's already maxed out all their other retirement saving options.
Okay.
Who's willing to leave money in the Roth IRA for at least 5 years to get that
Sure.
sweet spot.
Sure.
And who does not already have other Roth assets.
Okay. All right. So we're going to drop a link to a video in the pinned comment and the description below that we did on Roth IRAs explained. So make sure to check that out. Well, after this video, I guess. And while you're at it, if you liked the content of this video, hit that like button. Don't forget to subscribe so you don't miss another video from us. And if you have questions, always drop them in the comment section below. We do answer a lot in the form of videos. All right, Brian, any other parting thoughts or anything else you'd like to?
Yeah. If you're in that high income earner bracket and this is something you're considering, make sure you speak to your tax advisor first before doing this. So
100%, right?
Definitely.
Don't want to mess up with taxes. It will bite you in the butt. No, you're like, I'm the wrong thing. All right. Well, listen, we're going to wrap this video up. Again, if you like the content, hit that like button, help us grow this channel, show us you like our content, leave us a comment, and don't forget to subscribe. Until next time, everybody, thanks so much.
Thanks, everyone. Have a great day.